All right. Good afternoon and welcome to the Eastside Real Estate Team's podcast. I am Dan Edwards with the Eastside Real Estate Team, and I will be podcasting with you today. We're back from a bit of a hiatus. It is Wednesday, November 16th. And if you are watching this live, please press the like button, subscribe on our YouTube channel, whichever way you're doing it. If you're listening to this later, we hope you find this content interesting and engaging. Please do subscribe to a Google Podcast or YouTube or what's it called? Google Podcasts or anywhere else that podcasts are cast. I think we're on everything. So love to have you subscribe. Today, we're going to be welcoming Daniel Curry of Guild Mortgage and Dan Gelhay of Eastside Insurance. So we're going to have a Dan-a-thon today. It's going to be a lot of fun here on the podcast. But before we get to our guests, let's start with some real talk and address the big question. Why is today's housing market not like 2008? What's the big difference? Now, you can find a post about this on our blog at the eastsiderealestateteam.com, but we're going to just talk about all the headlines going out there and what everybody is saying in the world of real estate in the industry is that they're very concerned that this market is going to look a lot like 2008, where we had a record number of foreclosures, and eventually that turned into people looking for solutions on what we called short sales. Now, the good news is there's concrete data to reflect that there's nothing like that going to be happening. And the big issue is still supply and demand. Now, I know there's still a lot of things that are going to be shaking out in the economy over the next 6 months. So we expect a lot less consumer confidence that we saw, of course, over the last few years. But in 2008, there was more going on at the foundations of the financial markets that created a cascading effect that started in the housing markets, but didn't end there. It basically went global. So one of the interesting things to do is that when we look at the numbers, we look at a key index called absorption ratio. And absorption ratio is another way to say how many homes do you have in the market that when a home is sold, and if enough homes are sold in a specific time period, you would run out of available inventory. Now, in the height of this recent boom, we were as low as 1 week's worth of inventory. That meant a home came on the market and left the market. A home came on the market and left the market in a 7-day span. Well, that absorption ratio, as you could guess, because inventory being so low, creates highly competitive market, and it drives buyers to bid above asking price, waive inspection, to waive all contingencies, including financing contingencies, and also find alternatives to help them come up with cash offers. So we saw a lot of that going on, and what we found out is when the market changed, that changed too, and it was rather brisk, and that happened basically in May of this year. Now, what most people felt like was that the market was crashing, but the truth is that we were basically starting to normalize. Many would-be buyers decided to back away, and many would-be sellers did the same thing. So what we didn't see is people dumping inventory because they had to, like they did in 2008. What we really did see is we saw people that really had to sell list their home. Those that maybe could held off. Some of them may still sell, and it may be next year, and probably should have sold sooner in order to avoid what will look like a significantly lower price than they could have got this year. It might be next year, it might be even less. So essentially, around the entire nation, we have approximately 3.2 months of supply, 3.2 months of inventory. And the truth is a balanced market is 5 to 6. That's a balanced market. And that's where you get statistics like buyers are looking at 12 homes, kicking the tires, and then offering one. In this market, on the east side, we're actually still at just 2 months of inventory. Actually, 1.94 is what it is. So we still have a supply issue. And I have to tell you that builders are also pulling back their pace. And there's a couple of reasons for that. Supply issues is one, labor issues is another, And then they're seeing in the market that if they slow their build rate, they can actually keep their prices relatively higher. So they're not building. And many of the municipalities, cities and counties have a logjam of permits and essentially aren't really casting a lot of new permits in the area for new properties. So that actually keeps, especially with the influx, keeps prices high. All right. So let's see, what else we got here? So one interesting thing too that we're seeing in this market that we didn't see in that market is that there is a fair amount of equity that has built up since 2012, which is when the market really turned around. So 2008 to 2012 was the down years. 2012 to 2022 were the up years. So there's quite a bit of equity, and that's why we're not going to see that kind of crazy short sale foreclosure situation, because yes, there are some sellers that when they sold, if they had sold in say January, February of this year, might have earned $800,000, but now they're selling for $700,000. They still bought when it was $400,000. So there's still some equity. That means you're not going to run into the distress sales that we had. And so if a seller is not in distress, they may choose not to take that loss, but to stay in the house another 3 to 5 years. So in conclusion, there's a lot going on. And certainly the market doesn't feel like the fast-paced market of last year. Interest rates are causing an impact that creates an affordability factor for many, but creative agents are helping buyers work with their lenders to get a favorable rate by using what we call a rate buy down. And that's where the seller, instead of taking a lower price, offers credits to help reduce the actual cost of money to the buyer. Because to be honest, the buyer, they're buying the mortgage payment. Yes, they're buying the house, but they're paying the mortgage payment. And if the mortgage payment fits in their price point and they plan on being there 3 to 5 years, then having the seller finance essentially by crediting a lower rate makes a lot of sense. So if you're out there and you're thinking about buying, if you need to sell, we would love to talk to you at the Eastside Real Estate Team, and we hope that you reach out. You can find us online at the Eastside Real Estate Team, or give us a call at 425-200-4093. I'm Dan Edwards, managing broker with the Eastside Real Estate Team. Now, after our short break, we're going to welcome in Daniel Curry from, wait, maybe that's not what it says. Okay, well, we'll be back after this short break, and we're going to welcome Daniel, our lender. Come on back after this break.